SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to today's SUERF BAFFI Bocconi e-lecture dedicated to the evolving role of central bank capital in an era of persistent shocks and structural transformation. Building on insights from the new open access volume, Central Bank Capital in Turbulent Times, the risk management dimension of novel monetary policy instruments, this e-lecture today brings together leading researchers and policymakers to examine how unconventional monetary policies, digital innovation, and climate-related risks are reshaping central bank balance sheets and risk profiles. Across 4 focused sessions, we will explore the future of quantitative easing and the growing importance of balance sheet risks, the implications of digital money, crypto assets, and last resort policies for central bank profitability and resilience, the governance and political economy dimensions of central bank capital and independence, and the impact of climate change and the energy transition on financial stability and lender of last resort functions. We look forward to a forward-looking and analytically grounded discussion on how central banks can safeguard their capital while continuing to deliver on their mandates in an increasingly uncertain and politically charged environment. Before we start, let me thank the members of the organizing scientific committee, Dirk Broeders from the ECB, Art Huben, and Matteo Bonetti from the DNB for their help in shaping this program. Without further ado, let's start with session 1, which deals with the future of QE and rising importance of balance sheet risks. We start out with Christophe Erceg, Deputy Director of the Monetary and Capital Markets Department at the IMF. Chris, how does the IMF view the rise of QE since the GFC? What are implications for central banks' capital?
Well, thanks very much, Ernest. So I want to begin by thanking you and the organizers for inviting me to give an overview of my paper, which focuses on revisiting QE strategies as well as central bank balance sheet policies. This work is joint with Tobias Adrian and other colleagues in the fund's Monetary and Capital Markets Department. And the usual disclaimer applies. It represents our own views and not necessarily those of the fund. Given that we're in a more shock-prone environment and our star is low, central banks face a non-negligible risk of again being constrained by the effective lower bound, at least in the medium term. But an open question is what the recent experience with QE and QT in the post-pandemic period should mean for how QE is conducted in the future. A number of prominent economists have criticized QE for contributing to overheating following the pandemic, and QE exposed central banks to significant duration risk that ultimately led to sizable losses that can adversely affect central bank credibility. Accordingly, our paper considers the economic conditions that make QE likely to be warranted, as well as modalities of implementation, such as whether more use should be made of escape clauses. We'll also consider whether and how central bank capital policies, how the central bank distributes its profits, might be refined to better protect the financial autonomy of central banks. In evaluating QE, we argue that the appropriate methodological approach from a societal perspective is to assess the macro benefits against the consolidated fiscal costs. The latter take account not only of central bank losses that are often the focus of the financial press, but also how QE affects government expenditures and revenue. We use a DSGE model to explore quantitatively the effects of QE under different economic conditions. The model includes several key features. First, bond market segmentation, which allows QE to affect term premiums and hence long-term bond yields. Second, behavioral discounting, so that forward guidance is not an all-powerful tool, and there's some rationale for QE. Third, nonlinearity in the Phillips curve helps us capture the potential risk of overheating. We consider the merits of QE in rather polar cases of a deep liquidity trap characterized by a severe recession, as well as a shallow trap generated by a mild recession in which the economy mainly suffers from a low inflation problem. It's worth noting that our focus here is on using QE for macro stimulus when the effective lower bound binds, but financial conditions have typically already normalized. So our model has many standard features such as sticky wages and prices, and is calibrated to be broadly consistent with structural VAR evidence for the US and Euro area. The bond market segmentation parameters are calibrated so that the central bank purchases equal to 10% of GDP reduce the term premium on a 10-year bond by about 50 basis points. Details of the model are in an IMF working paper issued last summer. Turning to the simulations, QE is very effective in a deep liquidity trap. The blue line in the upper left panel shows output in a severe recession scenario that pins the policy rate at 0, the upper right panel, for 20 quarters. QE equal to 10% of GDP boosts output by about 0.75%, as you can see from the red dashed line in the upper left panel. This is significant, especially when recalling that many central banks engaged in QE of roughly twice this magnitude during the pandemic. Because QE doesn't have much effect on short-term interest rates in a deep recession, most of the fall in the term premium from QE passes through to lower bond yields, increasing QE's effectiveness. Moreover, QE lowers public debt significantly, as seen by comparing the blue and red dashed lines in the lower left, in sharp contrast to fiscal expansion that would raise public debt. Turning to a shallow liquidity trap associated with only a modest-sized recession, QE has similar qualitative effects in boosting output, again the red line in the upper left panel compared with the blue, as well as reducing government debt, the lower left panel, and raising central bank profits, the lower right. However, the size of QE's stimulus is considerably smaller, reflecting that QE induces an earlier liftoff of the policy rate in a shallow trap, so less of the fall in the term premium passes through to lower bond yields. Moreover, there's heightened risk that QE can induce overheating if the economic recovery proves faster than expected. This is seen in the upper left panel in the next figure, which is identical to the previous figure until period 5, when the baseline without QE, the black line, shows faster than expected recovery. So you can see it going up above 1%. QE in this case fuels macroeconomic overheating, the red line, as well as causes significant central bank losses, the lower right panel, the dashed line there. Some of the overheating in this scenario reflects that the central bank uses forward guidance to commit to keeping the policy rate low, the dashed red line in the upper right panel, rather than begin raising rates as called for by the Taylor rule, the black line. The upshot is that it's important to be cautious about deploying QE in a shallow liquidity trap, especially given other costs of QE, such as to market functioning, beyond the overheating and risk of central bank losses highlighted here. And any such deployment should be accompanied by escape clauses, which can limit the risk of overheating. We next turn to whether central banks should modify capital policies, how they allocate profits between building their own capital and distributions to the government to account for bigger and riskier central bank balance sheets. Well, the central bank's financial position shouldn't affect its ability to pursue mandated objectives if it has full operational independence. In practice, a weak financial position may weaken credibility and its operational independence. So central banks follow a wide range of approaches in distributing profits to the government. These policies were designed long before the global financial crisis, when central banks almost always were profitable. Some central banks, for instance, base distributions on whether capital exceeds a statutory minimum, while others allocate a fixed percentage of profits to the government. Despite differences, the broad aim is similar. If there are shortfalls, rebuild capital either organically, through profit retention, or possibly government recaps. While these approaches have the appeal of simplicity, they aren't risk-based or forward-looking. Accordingly, our work considers the merits of modest departures from existing frameworks that might serve to reduce the risk to central bank autonomy that could come from low capital or excessive profit variability. Given that QE usually generates large initial central bank profits, followed by big declines, it's natural to consider a smoothing through of some of the volatility and not simply distribute large upfront profits to the government. More formally, central banks could take a more risk-based approach. A dynamic capital policy would involve quantifying key sources of risk and making profit allocation decisions accordingly. In this vein, fund staff have developed a stress testing framework that builds on Hall and Reich to help assess balance sheet risks in a wide range of scenarios due to policy actions such as QE. Overall, we see considerable appeal in a risk-based approach in helping central banks maintain a strong financial position. Even so, this approach is more complex than most existing frameworks. For instance, when deciding how to allocate profits, should central banks look at the modal outlook or tail risks, which might require much higher provisions? And governments may be averse to central banks building up a war chest. The approach central banks ultimately take should depend on the risk they perceive of a weak capital position. Some central banks may view themselves as likely to have high operational independence, irrespective of their capital position, and want to retain their current strategy. But even in this case, enhanced communication can be useful. Other central banks may regard financial weakness as posing more risk to their ability to conduct policy and see more appeal in a risk-based approach, especially if it's difficult to rebuild capital organically from seigniorage. More central banks are adopting such risk-based approaches. To conclude, given that central bank balance sheets have grown enormously and are highly leveraged, it's useful to move forward to better quantify balance sheet risks ex ante and also further explore the merits of more risk-based approaches. Thanks very much.
Thank you very much, Chris. Let me now turn immediately to Christophe Kamps, Deputy Director General Monetary Policy at the ECB. Christophe, what is the current thinking on the ECB's future monetary policy toolkit? What role is there for QE? How does the ECB see proportionality and short versus long-term trade-offs, drawing on the strategy review and your current thinking?
Thank you very much, and thank you so much for inviting me for what is a great event and also a terrific book. And I'm very pleased and honored to be in a session with the other Chris. So, hi, Chris. I will basically, as you said, take a bit the perspective of the ECB, and especially since we concluded a strategy assessment last summer to basically review some of the lessons and put them into context also. I can already say that a lot of the things that Chris said resonate, and so I will add a little bit of the euro area perspective here and there. Given that I have just 10 minutes, I cannot go through the entire strategy assessment, and I will just cover a couple of aspects. But for those who are interested, there is a long paper of about 200 pages that summarizes the staff analysis that went into our strategy assessment, and it's available as ECB occasional paper. So basically, when we think about the toolkit, there are three aspects we have looked into in particular. And the three dimensions are the effectiveness of the instruments, the efficiency, and then the side effects. On the first slide I show you here, I basically cover the effectiveness dimension. The chart that you can see on the left-hand side is a meta-analysis that Eurosystem staff did in the context of our review. I basically looked at asset purchases, so QE, here we're talking about stance-geared asset purchases, then rate forward guidance, and our targeted longer-term refinancing operations. And basically what the meta-analysis shows is that there is a range of estimates on the effectiveness of the various tools. But by and large, the studies and the meta-analysis confirm that the three instruments do what they're supposed to do. They provide stimulus. And as said, there is some uncertainty on the exact magnitude of the effects. But that is, if you want, in a nutshell, the message from this chart. And so also the Governing Council last summer concluded that all the instruments that have been deployed during the lower bound period remain firmly in the toolkit. Now, that doesn't mean that, everything stays the same. There is no, let's say, nuances on how to use the instruments, and I'll come back to that in my 2 further slides. Well, clearly, and that is linked to the efficiency argument, what clearly is a lesson from the work we did is that rather than relying excessively on one particular instrument, it makes sense to combine the instruments, and with that also to take into account that we have for some instruments also evidence for diminishing marginal returns as tools are used more intensively or for an extended period of time. So when combined, the instruments tend to reinforce each other. But at the same time, and that is something we've looked in very deeply, also the blending of instruments can at times create problems. And I'll come back to a very particular concrete example at the end of my presentation. And especially this links to what Chris analyzed, namely, what if you have a dramatic and abrupt change in the inflation environment of the type we experienced after COVID. One of the things, and that's also what Chris highlighted, there is, of course, a trade-off between commitment and flexibility. When you're at the lower bound, of course, there is a type 1 error you can make, namely that you lift off too early. And so you enter into commitments, also time-bound commitments, to avoid exactly that risk. At the same time, of course, that reduces flexibility and increases the risk of type 2 errors where you may be late in reacting to a change in environment. And so at the end of the day, the instrument design has to balance these 2 aspects and find the right mix in addressing this trade-off. What is also something we have done in the strategy assessment is we have a careful assessment of all types of side effects of our instruments, be it on inequality, the housing market, bank behavior, sovereign behavior. But also one of the aspects that we looked at in 2025 that was less of an issue in 2021 was side effects on our own balance sheet. And so what we conclude from that analysis is that the losses we have experienced in 2023 and 2024 are, of course, sizable, but at the grand scale of things do not in any way undermine our ability to maintain price stability. On the left-hand side, you can see one type of analysis we did in the context of our report. It's basically asking the question, do we need to create extra inflation to maintain stable net worth of the euro system? And the answer, based on the evidence we have so far, is clearly not. So we do, on the left-hand side, you can see that the net worth stabilizing inflation rate is 0 or below 0. Where, when you compare that to our inflation target of 2%, there's clearly no reason at all to make monetary policy dependent on a net worth-based argument. But at the same time, as Chris said, there are communication issues as well, and that's also what we discuss in our report. And there is a lot of material also on our website, explainers, to explain what central bank losses mean also compared to private sector losses, which is one question I can see in the chat. One of the things that the council concluded is that when you have 2 instruments designed that are equally effective in delivering price stability, then of course the choice should be the one instrument that is more efficient, and that could be also in terms of implications for future central bank profitability. And all of this, what I mentioned, these 3 elements, effectiveness, efficiency, and side effects, those form the proportionality assessment that we are also asked to do by law. The European Union laws basically have this as a key requirement for institutions like the ECB, but not only us. And that is the way we put that into practice in our own monetary policy. And what you can also see in this box, which is an excerpt of our strategy statement, of course, the design, choice, and implementation of instruments needs to enable an agile response to new shocks. And that's a key lesson from what we experienced after COVID. Okay, maybe in my final slides, a few thoughts on specific lessons learned on QE. I mean, some are just identical to what I told you on the toolkit in general. QE remains an effective instrument, so it is an integral part of our toolkit. As also Chris highlighted, the effects of QE are state dependent, and also over time, the marginal impact may diminish. And so we have reviewed the literature on that, and actually Chris's paper with Tobias and others is a nice addition to that literature, and I think it resonates a lot. The side effects of QE have to be taken into account, like for all other instruments. And so indeed, QE, if you have a rapid reversal of interest rates, can have negative effects on the central bank balance sheet, although our analysis also from the latest episode is that those effects have remained relatively contained. And as Chris also showed, if you put against that the macroeconomic benefits and also the larger public sector balance sheet on that, QE has probably been beneficial. Now, one final point, because I said also the blending of instruments can be a particular problem. And one of the things we zoomed in was the policy setup at the ECB when we entered the inflation surge. And at the time of, let's say, end of 2021, the constellation we had was we had time-based guidance on our asset purchases. So we basically initially said we would continue QE until autumn 2022. And at the same time, we had in place a state-based rate forward guidance, which basically said, the moment we assess that inflation is on track to hit our target, the conditions are ripe for rate liftoff. And so there was a tension between the two as the environment was evolving so rapidly. And so that's certainly something also for the future to keep in mind. And then also to evaluate whether entering into time-based commitments is at certain points in time maybe something that needs to be revisited. And also maybe just a rejoinder to what Chris said, we would see escape clauses as particularly valid for time-based guidance, whereas for state-based guidance, we would see that as less necessary. But here, as I said, two instruments had two different type of guidance. And then at the time of the rapid change in environment, this created some friction. So let me stop here. Thank you very much.
Thank you, Christophe. We have 3 questions in the chat so far. The first one relates to the fundamental question, why do we care at all about central bank equity? The second one is, how good was the ECB's monetary policy, QE, in fighting the various crises compared to the Fed? I think Christophe addressed this already a little bit. And I think the third question we can in principle delay until Ulrich gives his presentation, because he will cover this in some detail. So maybe Christopher and Christophe, maybe you want to answer to the first 2 questions.
Yeah, maybe I can start with the first and then pass to Chris for the second, because it's more relevant for the ECB. But I think we do certainly recognize, as Chris said, that if a central bank has full independence, then its capital position really is not going to be consequential to being able to achieve its mandated objectives. Now, the problem, as Chris noted, is that there really can be important communication issues that arise. Central bank credibility could be adversely affected if the public perceives it as having a weak financial position. So, in that vein, some of the work that we've done is to try to underscore that even though central bank losses are oftentimes a focal point of QE, you see that really very prominently featured in the financial press, what really should be the appropriate sort of fiscal focus should take account not only the central bank losses, but of the revenue that would be associated with QE. If you boost output, then you're going to reduce some expenditures and boost tax revenue. And so that sort of I think communication can be very effective in making sure that the public understands that it's not just losses that matter for operations such as QE. So that's just a specific example of how central banks really can communicate about capital policies, and I think that can help be effective in giving them the latitude to continue to pursue them in the future. Now, in terms of importance of central bank capital positions, I'll draw attention to a recent study that Tobias was involved in with Lev Menand of Columbia University and Ashraf Khan of the fund. And there they do a survey of central banks over 10 different dimensions that are important for central bank autonomy. And this is a survey of over 80 senior central bankers. And it turned out that financial autonomy was at the very top of the list, that central bankers regarded that as more important than personal autonomy.
Thank you very much, Chris, also for this interesting reference. Christophe, what would you answer to the other question?
There was a question on QE during the 2007-2008 global crisis. And as is rightly pointed out here in the post also, is that QE was started at the ECB in 2015. So during the GFC, we did not use QE. There was a lot of instruments like liquidity operations deployed during that time. In 2010, also the so-called security markets program was activated, which was on a more limited basis and concentrated on a few countries. I mean, clearly on QE, there was a lot of skepticism in 2007, 2008. I think also the legal doctrine at that time was not fully developed. And so it wasn't clear to what extent the ECB could deploy QE on a large scale. And I think this, by now, 2026, we know that QE has become a full-fledged legitimate instrument at the ECB. And it's right that it was not part of the tools deployed in the global financial crisis. There was a second question then on wealth inequality. And so that is something we have looked at also in our strategy paper. So if you look at our report, you will find a section on that. So we basically looked at two things. One is wealth inequality, where the evidence is mixed. There is some papers also produced in the Eurosystem that would say, yes, there is some increase in wealth inequality, which then has tended to reverse during the period of quantitative tightening we are currently in. And the other aspect is that the evidence we have seen finds that QE has reduced income inequality. So it has actually helped to avoid deep scars of recession. So, for example, after the COVID crisis, one could have expected to see in Europe a return of hysteresis. And so QE was one contributing factor, not alone because there were a lot of government measures, but that is in a nutshell what we found in our recent paper.
Thank you very much, Chris and Christophe. This ends our first session. Let me immediately turn to a second set of important structural developments which are shaping central banks' balance sheets and operations. Digital money in all its forms, be it private digital money, be it public digital money or CBDC, and also central banks expanding lender of last resort actions. Again, we have two outstanding speakers in this session. We start out with Ulrich Bindseil, honorary professor at TU Berlin and SUERF fellow. And important for this session here, former Director General for Market Infrastructure and Payments, and before that, Director General for Market Operations. Ulrich, what implications may we expect from CBDCs and stablecoins for central bank balance sheets and profitability? Over to you.
Yeah, thank you, Ernest. Thank you for having me. That is also, of course, a work that was published in the volume of Dirk and Matteo. And we also, together with, and it's joint work with Marco Marazzo and Stefan Sauer, and we have an extended version of the paper in an occasional paper series of the ECB. And then I will say some words on stablecoins, and that you find in that paper that I referred to on the slide below. So, short introduction. central banks are unique in terms of capital needs, because they have the right to issue legal tender and they are therefore not threatened by illiquidity, and financial insolvency is not a problem to the same extent as for anybody else. And on top, they are normally structurally profitable because of their exclusive right to issue unremunerated central bank money. But the only central bank money issued to the public so far have been banknotes, and they are being used less and less, as we know. And ultimately, one can expect that this will also bring down the volume of banknotes and thereby undermine the second point of central bank uniqueness. So their structural profitability will ultimately suffer if that is passively, just accepted. Central banks work on CBDC as a consequence of the decline of the use of banknotes. And CBDC is not an outrageous, crazy idea. It is just about preserving the coexistence of central bank money and private money in a digital age where people no longer pay with banknotes. And in a certain way, it is therefore a conservative move. It is just keeping the two-layer monetary system. And it's just natural, that everybody else has gone with digitalization. All the paper instruments that also banks use to issue, like bills of exchange or checks, have disappeared. And it's just natural that the central bank does the same. Important for our context here, it is a way to preserve the role of the central bank and not to expand it. And then central banks have worked on CBDC, like also the ECB in particular, on digital euro. And some design choices have emerged that are relevant also for the income implications of CBDC. First one, CBDC would be unremunerated, same as cash. Then there would be limits per capita. There would be access criteria in the case of the digital euro, only domestic natural persons. And then there will be something called, for digital euro, called reverse waterfall, which allows users to not warehouse digital euro, but to use it like a PayPal account. You don't have to put there anything, you just pay, and your wallet takes the money instantaneously, in the case of digital euro, from your commercial bank account that you had indicated. So all this implies that volumes will not be very high. What we did in the paper was quite a scientific exercise, which is shown here on this slide, but I will not go through this flowchart. It shows all the parameters in our modeling of the likely size of CBDC, the volume and the substitution effect with banknotes, and leading us to, predicting the balance sheet effect. But one can simplify this problem radically, and that's done in this little red formula. So the net impact on profits of the change in the supply forms and demanded quantities of central bank money is simply the expected delta of the total banknotes plus CBDC times, of course, the short-term interest rate level. And all of those factors are subject to large uncertainty. But I think it's fair to say the picture is not rosy anyway for the central bank. Banknotes will decline. CBDC has been designed, I may say, under pressure of the industry to have low quantities, and interest rates are expected also to not get very high those days. With low inflation and low growth, I will not be so high. So overall, I would say expectation on seniorage income are not rosy. I see this on a downward path, even if one introduces a CBDC in the way digital euro is designed. I may say central banks in many countries allow themselves to be cornered and often were not very good in defending the interest of society against the relentless efforts of the industry to prevent CBDCs, paving the way to a phase out of the use of central bank money, which of course for the private sector players has lots of advantages. So the fee generating payment volume increases, the pricing power in markets, in payment markets with strong network effects increases in the absence of public competition. The monetary base, the share of the monetary base of the private sector increases, and thus the seigniorage income earned by the private sector, but not the one of the central bank. And if you look at this Navarrete European Parliament proposal, which prescribes a limit calibration, it is, if you would implement that, I think the limit for CBDC for digital euro per person would be below 100 euro per person. So it would, really make those effects very strong. Let me turn to stablecoins for 1 second. So are stablecoins now the common enemy of both banks and central banks in terms of profitability? And the question is, stablecoins, where does the money come from and where does the money go to? And then you can draw the flow of funds, though, that a stablecoin growth implies. And if you assume households finance their purchases of stablecoins, households and NBFIs share off better by reducing sight deposits with banks, share mu in the form of banknotes, and the rest reducing holdings of debt instruments. And then you have to ask also yourself, where do the stablecoins invest the money? Say alpha goes in the form of commercial bank deposits, a share beta in the form of deposits with the central bank, if that's allowed, and the rest into short-term high-quality bonds and bills. And then if you assume a stablecoin of total value C being created, then you can draw the flow of funds and you can see how the central bank and commercial bank balance sheets are evolving, including, of course, on the attractive liability items, which is the sight deposits for the commercial banks, and for the central bank, the banknotes issued and stablecoin deposits, if you have that, if you allow that, and depending then, of course, on the remuneration of stablecoin deposits. And then, even, of course, if the money comes from the same sources as it flows into, so if beta equals alpha and mu equals delta, then in the one country model displayed above, nothing seems to happen. But of course, that's because it simplifies a bit the details away. So of course, households and NBFI hold lower average credit quality bonds than stablecoins, and also longer duration bonds. So you will have, preferred habitat effects and changes of relative yields if you have big inflows into stablecoins. And also stablecoin deposits with banks are unstable and expensive and concentrated deposits then compared to household deposits. So for the banks, the beautiful seigniorage income, quasi-seigniorage income earned from retail deposits goes away, even if the stablecoins deposit with commercial banks. So the MiCA style requirement of 60% stablecoin deposits with households, with banks for large stablecoins is not, really helping the Sparkasse in the small town, because the money flows to, a big global deposit collecting bank probably. So bad for banks, I think, stablecoins. And at the end, you can also build a two-country case, and I won't go to the detail. 99% of stablecoins are US stablecoins, and India and maybe Europe and African countries are all afraid of this global circulation. So the question is, how does that affect the balance sheet of banks and central banks in those user countries? So here in this flow of funds chart, country A is the US and country B is any other country in the world. And D is the amount of stablecoin circulating in that country. And here you have then a template for the effect on cheap liabilities that a foreign stablecoin has on your country. Let me stop there. Thank you very much.
Thank you very much, Ulrich. Now, let's turn to another aspect that the future environment will be characterized by. Kathryn Dominguez, who is Associate Dean for Academic Affairs, Professor of Public Policy and of Economics at the University of Michigan. Kathryn, how do central banks' last resort policies structurally boost central banks' balance sheet?
Thank you, and thank you for organizing this event and for inviting me. And we will kind of harken back to some of the things discussed in the first session, since we'll be talking about, as one of the last resort policies, quantitative easing. So this paper is looking at what policies central banks often described as extraordinary interventions, but the policies that they put in place in times of crisis. So I'm really looking at the pandemic era policies that were used across the globe. And you can put these last resort policies into two main buckets. The first is the unconventional monetary policy that was discussed in the first session. So that would be quantitative easing, and I will also talk a little bit about quantitative tightening. So again, in the immediate stages of the pandemic, it was clear the central banks around the world needed to put in place policies that would stabilize financial markets and also the economies as things were closing down. So quantitative easing, and many of the countries at that moment had interest rates near the zero lower bound or at the zero lower bound. So quantitative easing was a clear policy that most countries took, and I'll show you the data on that in a moment. The other two last resort facilities, and again, every central bank had a different version of this, include something that actually Willem, who's speaking later, and I have described in another paper as enhanced lender of last resort facility. So this is, again, indirect liquidity provision, like we would normally think of as lender of last resort facilities, but this is now to a much broader set of borrowers on very different kinds of terms and often with different definitions of collateral. And then I'm also going to talk about the market maker of last resort facilities that a smaller number of central banks, but 13 of them around the globe, put in place, where this was direct liquidity provision, where they actually outright purchased a number of assets, often assets that those central banks had never before purchased, again, as a targeted measure to try to stabilize specific financial markets. So I'll go into a little bit more detail in a moment. So we learned some lessons before the pandemic, and those lessons ended up being used. So I think one of the things that came out of the 2008 financial crisis was this view that central banks had typically done too little, too late. And so when the pandemic hit in March 2020, there was a sense of we've got to go big and we got to go fast. Mario Draghi is often given credit for the idea of whatever it takes in his 2012 promise for the Euro crisis. And I think that lesson was very much taken by a lot of central banks in March 2020. So in a paper with Andrea Foskey, we look at announcements by different central banks in that March period and subsequently. And we find that when they described the policies they were going to put in place as open-ended, so they weren't going to say by how much, and in fact, they said, in many cases, we'll do whatever it takes. When we add those announcements up across different central banks, we find that on average, those central banks actually were able to reduce their yields, and in many cases, this is their 10-year yield, so long-term yields, by almost 50 basis points. So they had substantially larger impacts than the kinds of announcements that central banks typically make, which are much more measured with an actual size and a time limit. We also found that the first announcements that were made tended to have the largest effects. And a lot of those announcements were made in combination, as I'll talk in a moment. So there was some synchronicity to that. And the other thing we found was that often the announcement effect was much larger than really could be understood given the likely longevity of the program. So basically, markets really reacted strongly to these announcements. So I mentioned before there were very dramatic peer effects and policy synchronicity. I'm not going to call it coordination. My guess is there was some explicit coordination, but there seems to have been a sense that once a few central banks came out with statements that other central banks felt at the very least pressure to go ahead and do the same. And in the paper, there's sort of a very detailed list of exact timing across central banks, but we had a lot of central banks coming out right in the first few days, again, with these very strong whatever it takes announcements. And these were very front-loaded announcements. So the idea, again, markets were in disarray in March 2020. So a lot of these announcements were specifically to stabilize financial markets, but they came in strong and they came in fast. When we actually look at the total amounts that central banks used in these programs, they ended up being much smaller than what you would have implicitly expected, or what the markets expected. Ended up being larger than what actually happened. And that's the perfect outcome from a central bank's point of view. Say something, get the markets to move, and then not actually have to do as much as you might otherwise. There were probably lower cross-country spillovers, in part because all the countries were doing the same thing. You can see these are currency values against the US dollar starting off in 2020. And even though we had these huge announcements of really dramatic policy changes in those early days or mid days of March, we really don't see really dramatic currency changes, which we normally would expect to see, in part because all these central banks that I have listed here are the countries with these currencies. We're all doing exactly the same thing. So currencies are relatively stable during this time period, given the size of the announcements made. So let me talk a little bit about those enhanced lender of last resort facilities that I mentioned. So traditional lender of last resort is emergency lending, typically to regulated banks experiencing liquidity difficulties, but banks that are not insolvent. During the pandemic, the central banks typically really lowered the criteria that had previously been in place. They offered loans to a larger range of institutions, far beyond just the regular traditional regulated banks. They included non-bank financial institutions and even some non-financial firms, something that for most of these central banks they had never done before. They did so on preferential terms, with a very wide range of collateral, in many cases where we had no idea what the value of that collateral was, given the instability in financial markets. So the implications for central bank balance sheets could have been quite dire. These operations were often financed with bank reserves. They didn't need to involve balance sheet expansion. They could have just been a swap for risky, swap between risky and safe assets. They often did involve balance sheet expansion, but by all measures, these operations definitely increased the risk of the balance sheets on for most central banks, because they were holding assets in many cases where valuation was very unclear. Market maker of last resort facilities, again, as I mentioned, are very uncommon by central banks, but many central banks did in fact actually outright purchase assets, which again, they normally would not do in normal times. They did so in order to sort of unstuck specific financial markets. Many central banks were actually prohibited to do this, the Fed being one of them, so they had to invoke Section 13.3, basically the Emergency Act, in order to be able to do this. The Bank of England and the Bank of Canada likewise made these purchases with government indemnity. Only 13 central banks did these market maker of last resort purchases, and they included purchases of all kinds of things that we normally don't see in central bank balance sheets, including municipal and corporate bonds, commercial paper, mortgage bonds, equity in some cases. And it's hard to imagine that all of these assets on the balance sheet did not increase balance sheet risk. So this is just a picture that I think most of us have seen. This is the incredible increase in balance sheets across the globe. This is colored by country. So the ECB is on top I guess that would be gold, the US below in blue, Japan in green, and so on. But all central banks were really dramatically involved in purchasing assets and expanding their balance sheets. Just as we saw this dramatic increase in balance sheets, we then saw a very dramatic shift as the global economy rebounded. Inflation started to rise. Most central banks who had thought they'd go from QE to neutral all of a sudden had to very quickly shift to quantitative tightening. And so we saw lots of different ways in which central banks did so. This is kind of a table that nicely kind of describes a number of central banks here when they first started their QE operations, their peak balance sheet date, and then when they and how large the increase was. So you can see Canada there at the largest at 400%, the date of the first QT announcement, and then the amount of decrease, again, Canada being the largest over the period that I'm looking at, and then the date of the first policy interest rate increase. So this has already been mentioned, and I think it will not surprise anyone that this set of operations, both the quantitative expansion or the quantitative easing, the purchases of assets, and then the quick tightening and therefore the rise in interest rates, led central banks to suffer some pretty significant and dramatic losses. So we had Canada announcing a net loss for the first time in its history, Japan having the first large loss in 17 years. This just gives you a list of the dates on which they announced the losses, and in many cases, kind of very unusual situation for each of these central banks to have to mention losses. Again, totally predictable given the policies that were put in place. So what do we conclude about all this? I would say the first and most important thing is that these last resort policies that were used during the pandemic, both were looked like they were very effective, and they significantly expanded central bank balance sheets across the globe in a way that we'd never seen before. I would say that market reactions to this very dramatic set of events was very positive. Basically, central banks announced their policies, especially when they announced that they were going to go big. Yields dropped dramatically, and there was very little dislocation when central banks had to quickly turn on their heels and shift to quantitative tightening. Again, something we didn't really know how that would go, and it went very smoothly. So I guess what we're left with is, what are the long-term costs? So this was a set of policies that looked like they were very effective, but are there things that we need to take away from this experience that might impact future decisions? Well, it certainly does escalate expectations. We saw lots of central banks do extraordinary things, and the question is, next time something happens, unless there's another set of extraordinary actions, will markets react poorly? There's always the concern that this leads to more moral hazard and financial fragility, although I would say that so far we don't see any real evidence of that. And then there is this issue of the legacy of expanded balance sheets, and that continues to be the case for a lot of central banks. I would say that there was a very muted response to these losses on central bank balance sheets. Much less concern in the markets than many people had feared. I think a lot of that comes from the fact that there was such synchronicity across the globe. All central banks were doing this at the same time, and they all faced losses at the same time. And these extraordinary policies did not come endogenously from a financial market set of crises, but rather from the pandemic, from an external shock. And I do think that we might have seen different kinds of reactions had this set of policies been put in place in reaction to something that was actually going on in the financial markets. So I'll stop there.
Thank you very much, Kathryn. Meanwhile, we have one question from the chat by Joachim Fels, old friend. How should we think about the optimal holding limits for CBDC that balance the need to avoid endogenous bank runs into CBDC against the desire to preserve a source of seigniorage? What would be a reasonable range for such holding limits? Maybe Ulrich wants to start.
Yeah, that's the mother of all questions on the CBDC, and there has been a lot of effort of the ECB to estimate what is on the safe side, and I think it has gone public with some elements of that. And I mean, if I may say, the discussed range of whatever was mentioned, 3,000 to 5,000 euro, is, I would say, the lower bound, because we are, in a world where nothing is limited, where deposits can flow out from banks into anything. The central banks put a limit on their contribution to modern forms of payment, and we are talking about something that is not yet existing, that is not yet successful. So we are overdoing it if we put the limit in the most risk-averse way, and therefore, I mean, my vision would be that it should be not lower than 5,000, just to give a number.
Thanks for the effort to give a concrete number. Maybe a little, also a question for Kathryn. Now, in your last slide, you mentioned a couple of risks from market maker of last resort, lender of last resort, from mission creep in a way. So where, in your view, given current and forthcoming developments, rise of NBFIs, rise of stablecoins, repeated needs for treasury market interventions and whatnot. So where should be the limits to central banks, lender of last resort and market maker of last resort function?
So another great question. Of course, I think central banks would prefer not to have limits. And in fact, I think if there were explicit limits, that actually could put markets in peril. I think what would be best is if they can suggest that they will be able to intervene without actually having to intervene in a large way. But if you put in place limits, that then immediately gets markets worried that in fact liquidity might not be restored. So it's a balancing act, I think. Most central banks now have done this kind of set of operations in ways that they might not have ever thought they would in the past. But I don't think that they're eager to do it all the time. But I think typically their preference would be to have these as standby kinds of facilities that could be used in times of crisis, and would prefer not to have any limits on the size that they could, in principle, go in for.
Thank you very much, Kathryn. This reminds me a little bit of the current discussion about defense in Europe. You want the threat, but you don't want to use it ever. But you need the threat not to use it ever. Okay, so thanks very much, Ulrich and Kathryn. This brings us to our third session, which addresses the question to what extent central bank's financial position is or is not relevant for central bank independence and for the central bank's ability and commitment to maintain price stability. To discuss this, we have again three outstanding speakers with us. Let me start with Willem Buiter, who is well known as a brilliant and critical professor of economics, an independent member of the Bank of England's MPC, then chief economist of Citi, and now an independent economic consultant. Willem, why are the analytics of the topic so simple and the politics so complex?
Thank you, Ernest. It's a real pleasure and an honor to participate in this. The central bank's balance sheet matters because central banks are fiscal and financial agents of the state. They are beneficially owned by basically the treasuries, the Ministry of Finance. This incidentally means that for fiscal sustainability, the consolidated general government and central bank have to be considered. Most of the capital losses made since the great financial crisis, especially since COVID, by the central banks were on claims to the government, on government bonds. So that's a capital gain for the government. And provided there's proper profit sharing or recapitalization between central bank and the fiscal authority, these capital losses for the central bank are quite irrelevant. Case. The conventional balance sheet of the central bank is a very poor guide to its cash flow insolvency risks or so-called equitable insolvency risk. It also tells us very little about whether it can pursue its price stability mandate and financial stability mandates. To establish that, you have to look at the intertemporal budget constraints of the central bank, or also known as the intertemporal balance sheet, or I call it the comprehensive balance sheet. One, to start with, the conventional balance sheet, even if it was inclusive and valued its assets properly at market prices and didn't have phony assets like the deferred asset, it would really overstate the weakness of the central bank balance sheet, because central bank monetary liabilities are a liability in name only. They're irredeemable. It's a claim on itself. This applies not just to cash, but I believe it applies to deposits held with the central bank, and it will apply to CBDCs. So if you look at the intertemporal budget constraints of the central bank, the recognition that central bank money is a liability in name only increases its net worth by the value of the outstanding stock of central bank money, plus the present discounted value of all future net issuance of central bank money, minus interest paid on central bank money. So this means that basically everybody gets the intertemporal budget constraint of the central bank wrong. There are two important differences between the conventional balance sheet and the intertemporal balance sheet, which includes the present discounted value of future non-contractual payments and receipts as assets and liabilities. The main asset is this present discounted value of future monetary issuance, seigniorage, and the main sort of liability that isn't in the conventional balance sheet is the net payments made by the central bank to its owner, the beneficial owner, the treasury. Incidentally, just on CBDCs, they will allow the central bank to avoid the need for QE driven by the ERB, because the effective lower bound can be abolished by abolishing paper cash, zero interest rate cash, and introducing an interest-bearing CBDC that can go deeply negative, if necessary, on its interest rates, and is retail, available online and offline, and without caps or limits on the size of the deposits or indeed the transactions in it. If this creates problems for banks that lose deposits, the central bank can simply redeposit the money or lend it some other way to the banks that are losing money. So that's not an issue. A number of central banks do have proper profit and loss sharing, symmetric ones with their own treasuries. The Bank of England has a profit and loss sharing agreement for the central bank, and also has a recapitalization agreement with the treasury. The Fed has no such thing. Its profits go to the treasury, but nothing is said about the treasury commitment to compensate it for its losses. Just to see the magnitude of the part of the monetary non-liability of the bank, the Fed has official capital without the variable interest entities in it of 46 billion, but its currency liabilities are 2.2 trillion and its domestic bank deposits are 2.8 trillion. So there is no solvency problem for central banks as long as they have no serious foreign currency liabilities, which is not the case in any of the advanced economies you look at. You can, of course, be in deep trouble as a central bank if you have large foreign currency assets and your currency appreciates madly. This is what caused the Swiss National Bank to suffer a loss in 2012 of 17% of GDP, which is serious money by any standards. I believe, therefore, that it is really important for central banks to have this symmetric recapitalization and profit and loss sharing agreement. Central banks, I think, will also should also encourage, in addition to issuing CBDCs, the issuance of stablecoins. These stablecoins should be fully backed 100% and held in distinct legal entities, fully backed by either central bank deposits or short duration treasuries. Again, this could lead to a demonetization of conventional banks, which I think would be a good thing, because the fact that institutions that provide serious loans to the private sector are also engaged in creation of money creates bank run problems that leads to deposit insurance and lender of last resort facilities that encourage excessive risk taking and that then lead to over-regulation of the banks. So demonetization of the banks by CBDCs and by 100% backed stable coins would be a good thing. Again, if there's an intermediation problem that the banks loses access to these deposits, the central bank, both acting for itself and on behalf of the treasury, can redeposit the money with the bank. So they can still lend, however, this time without the risk of bank runs. So I think if central banks are smart, go ahead with deep account, we could get a strengthening of the monetary system. Let me just say two more things about the conventional balance sheet. It does matter because it's an important component of the intertemporal budget constraint, but governments like the Fed, so central banks like the Fed and the ECB have introduced a mixture of a conventional balance sheet and partial intertemporal budget constraint by adding deferred assets, the net present discounted value of the profits they will have to make before they resume payments to the beneficial owner as a result of large losses, right? These things are phony assets. The banks say that this doesn't affect their solvency risk or their ability to implement the monetary policy purposes. That is absolutely incorrect, because the profits may not be there, or they may only be there through excessive money issuance or through transfers from the treasury to the central bank, which may not be available. So the deferred assets, sometimes represented by negative liability, as the ECB does now, should be immediately struck off the conventional balance sheet. And finally, not valuing assets at market value or fair value, if it's non-traded, leads to massive misstatements. We can see the deferred asset for the Fed, the cumulative losses that would have reduced its net worth, conventional worth below some critical value, went from 2.2 billion in 2022, it had been zero before that, to 242 billion in 2025, end of Q3. The unrealized capital gains, because most assets are valued at amortized historic cost, went from a cumulative capital loss of 404 billion in 2020 to a maximum capital loss cumulative of 1.3 trillion. And even today, when you ignore the deferred asset and value assets at market value, as you should, the Fed's conventional net worth is still minus $1 trillion. I don't think this necessarily affects their ability to control prices, because this would create a need for solvency to expand future base money in an excessive manner, but that should be checked. And if we get another event like this, take another $1 trillion of the balance sheet, it could well be necessary for the Fed to either get recapitalized by the Treasury or engage in base money creation inconsistent with price stability. So there's a lot to look forward to. Thank you.
Thank you very much, William. Let's now turn to Dirk Broeders, Senior Lead Financial Risk Expert at the ECB. Dirk, how does central bank capital influence the shareholder relationship with the central bank's owners?
Yes, thank you, Ernest, and good to see everybody. So my talk today is indeed about something Willem just also addressed, namely the relation with the shareholder. And this is a paper written together with Matteo Bonetti and Damian Chen and Daniel Dimitrov. By now, we all know that, of course, that central bank monetary policy operations involve financial risk taking. And obviously, central bank capital serves as a buffer to absorb the potential losses of financial risk taking. And this already has led to questions in the academic literature on what the optimal level of central bank capital should be relative to current risk taking, but potentially also to future risk taking. Yeah? So central bank balance sheets are dynamic, and especially in times of crisis, as Kathryn showed, they grow, and this means also more financial risks in the future. Now, what we do in this paper is that we take a specific angle to study this problem by looking at central bank capital policy as a risk-sharing arrangement or a risk-sharing contract between the central bank and its shareholders. This risk-sharing contract basically consists of two mutual obligations, and we take the central bank perspective here. First of all, the central bank is at arm's length of the Treasury, and It pays dividends to the Treasury if the central bank is well capitalized. For those of you familiar with option theory, this means that the central bank has a short call option on its own assets. The reverse is also there, so the shareholder either explicitly or implicitly commits to recapitalize the central bank if necessary, if feasible, if it's contractually agreed upon. And from the central bank's perspective, this is a long put option. So we're looking at two explicit or implicit options. And there are a few relevant considerations. These option values are driven by the central bank's risk profile. So driven by the monetary policy operations. And key, of course, here is the understanding that central banks do not hedge interest rate risk. Now, obviously, since the central bank is integral part of the state, any transfers between the central bank and the state are a zero-sum game in valuation terms, etc. But you can still argue that these transfers of money serve a different purpose. If it's on the central bank's balance sheet, it can contribute to central bank credibility and independence. And for the state, it can help to finance expenditures. But the differences are actually more subtle than this. For instance, the central bank has a balance sheet with fair value accounting or amortized cost accounting, versus the state, which doesn't have a balance sheet. It uses cash accounting, and it also focuses more on debt only. And the last point here is recapitalizations can take two forms. So external, in the sense that the state or the treasury transfers cash or government bonds directly to the central bank, versus the internal, where Willem was talking about the deferred asset that suspends dividend payments until the central bank is fully capitalized again. We can analyze how the risk profile of the central bank influences these options. So let's define equity not purely as what we see on the balance sheet, so accounting capital, but let's include the value of future dividends and also the value of this recapitalization option. And what we show in the paper is that the risk profile of the central bank influences the value of equity, including these options. It's a bit of a complicated chart or charts, but what you see on the right-hand side is on the x-axis the risk profile of the central bank, sort of a proxy of QE or the asset liability mismatch. And on the y-axis you see the value of equity, so including the recapitalization option and the dividend payment option. And you see that for a central bank which has positive equity, is well capitalized, actually risk taking would reduce the value of its equity, versus a central bank which is undercapitalized would actually increase the value of its equity by taking more risk. And this, of course, there would have to be weighed against the risk taking that is necessary to implement monetary policy. Why does this matter? So central bank capital contributes, in my view, to central bank independence, financial independence and credibility. And you can think of central bank capital when it's positive. It means that the state, the treasury, has a claim on the balance sheet of the central bank, which you see here in the left-hand stylized balance sheet. But as soon as the central bank enters into a territory with negative equity or this deferred asset, then it actually creates a claim on the government, and that could sort of have consequences in terms of central bank independence. A deeper question is how central banks actually absorb financial losses. Because we focus quite a lot in the discussion on central bank capital. But actually in practice, there are multiple ways to absorb losses. Not in all cases, but typically there's a multi-stage sequential process where the losses are first absorbed by buffer decumulation. And if this option is fully used, then there are basically two options left, namely loss deferral, where you put it on the balance sheet either as a deferred asset or a negative liability, as was well explained by Willem just now. And the alternative is recapitalization, and also there we see different flavors, either automatic, as we will learn in the next presentation, but it can also be more ad hoc, driven by a negotiation process between the central bank and the state. Now, in this process, accounting is really key. So choices on fair value versus amortized cost, recognizing a loss as a deferred asset or negative equity, all influences the timing and the visibility also of the financial implications of monetary policy. And this also leads to communication challenges in terms of what do you disclose as a central bank on the impact, both positive, as was addressed in the presentations early on in this seminar, versus the losses that may occur. Let me end my presentation with one more slide. So what could be, or what are the lessons learned? Well, it's clear that central banks can operate with negative capital, but it's equally important that there's credible fiscal backing. Because if equity is weak, at some point there is a sort of a tipping point, which was identified by co-authors from the BIS, where at some point, consumers and business might lose trust in the currency and start using alternative currencies. Obviously, we're very far away from that, but there are scenarios thinkable where that could happen. Another point is that from an ex-ante perspective, calibrating capital or quantifying potential losses is extremely difficult because central banks face a lot of uncertainties in terms of data and modeling of current risk exposures, but also future risk exposures and all sorts of nonlinear system interactions that we only start to understand in a world of geopolitical uncertainties, cyber risks, climate change, and also the rise of digital monies. So bottom line, I guess, going forward is that the shareholder should adapt to a situation where dividends are more volatile than they have been in the past, potentially also prepare for recapitalizations as a measure of ultimate necessity, while the central banks obviously need to stay financial independent and operational independent, not connected to short-term political stress and budget pressures. Thank you.
Thank you very much, Dirk. Let me now turn to David Vestin, a senior advisor at the Riksbank. David, what is, judging from your research, the relationship between central bank capital and central bank independence?
So thanks a lot. Thanks to the organizers for putting our paper on the program and also in the fantastic volume that we're here to sort of launch. What our paper do in a nutshell is essentially to provide a discussion of the various reviews, parliamentary inquiries that led up to the new Riksbank Act that was enacted in 2023. We discuss the new capital framework and we offer a sort of a quantitative model that can be used to assess the need for how much equity the Riksbank needs to hold given this new framework. And you might wonder, why should you be interested in Sweden? And I would say there are three arguments why why Sweden is relevant in this context. The first one, as Ulrich alluded to, is that cash is declining. That's a feature for many countries, but Sweden has been in this situation for a very long time, and we are very well advanced into this sort of, for seniors perspective, negative trend. So cash is now below 1% of GDP, which means that our seniors revenue is much lower than historically. Of course, also influenced by factors as low nominal interest rates. The second reason, as Wilhelm alluded to in one of his slides, is that Sweden is one of the examples that actually have a very explicit framework for recapitalization and for capital policies since a few years back in the new Riksbank law that lays out the details. And the third reason is that we actually had a recapitalization of the central bank only a couple of years ago. So for these reasons, let's look at the next 4 slides that I have. So essentially, there are 2 reviews I want to mention. The first review came out, and as a background, in Sweden, when things are supposed to get done, typically politicians commission these kind of reviews to prepare and come up with proposals for changes, and then those changes are enacted by Parliament. And the first review in this context came in 2013, and it had a very simple logic for a capital framework. It essentially argued that capital or equity is part of cost-free funding. It sort of made the point that the operational expenses of the Riksbank was around 0.75 billion Swedish crowns, and it assumed a real interest rate of roughly 1%, and therefore came to the very simple conclusion that if you divide 0.75 by 0.01, you have a need for a cost-free source of funding of 75 billion. And then the inquiry or review sort of argued that you should add cash, outstanding cash, as well as equity, because those 2 are the key components of the cost-free funding for the central bank, and have a target level for those. And the review argued that there's a very small need for a capital buffer for 2 reasons. One is that they had recommendations on having a relatively small balance sheet. So this was pre-QE era. And it also had a very clear recommendation for an automatic recapitalization rule. Then, for various reasons, nothing happened for a few years, and there was another review commissioned of a much larger scale that actually opened the entire Riksbank Act up for review, not just the capital framework. And what came out of that review was a proposal which was in spirit pretty similar to the one from the Flam review, but it had some important modifications. And one was that it did not consider cash an explicit, it didn't consider the sum of cash and the capital or equity. It rather had a clear focus only on equity. The second thing was that it didn't provide an automatic recapitalization rule the way that Flam wanted, but rather came up with the idea of having a target level of equity for the central bank and also a minimum level of equity. And the sort of replacement for the automatic recapitalization rule was that if equity falls below this minimum threshold, which amounted to 20 billion Swedish crowns indexed to CPI, then the Riksbank was mandated by the law to initiate a recapitalization discussion with Parliament. So what we come up with is essentially, given this framework, we come up with a quantitative model so that you can actually assess what is the likelihood of the central bank running into trouble, in the sense of running into issues where we actually have to go and do a recapitalization. And this framework is quite simple. So it's based around a Bayesian NBER model that tries to model the joint evolution of all the variables that drive key components of the financial results of the central bank. So we're talking about interest rates of various maturities, exchange rates, inflation, and some gold price adjustment as well. But that's not so important, as we might have time to come back to. Then there's a financial block that sort of makes sure to map all those evolutions of the driving financial variables into the actual profit and loss statement of the central bank. So respecting the way the portfolio looks currently, making some assumptions about how the portfolio composition will evolve also going forward. And then, given that we very much agree with Wilhelm's discussion from the first session about what is really fundamentally the need for central bank capital should be put in the context of the intertemporal budget constraint and everything like that. But as simple, humble servants of the Riksbank, we are actually, confronted here with a very clear rule that says, irrespectively of this sort of logic, now we have a framework that says if equity falls below 20 billion, That's it. That's a recapitalization. And that means that our task is much easier in the sense that in order to simulate if a recapitalization will happen, we don't actually need a full-fledged theory over the issues that Willem was discussing. It's sufficient for us to actually model just the joint evolution of the macro variables, link them to what will happen to the profit statement of the central bank, and then compare to this index 20 billion, which is the recapitalization rule. And what happened in the Swedish context was that exactly on the same day as the law was enacted fully, the 1st of January in 2023, the Riksbank reported a tremendous loss. So you see the pink line on the left-hand chart, where you see the big dip. That dip occurred the same day as the new law came into place. And of course, the law specified that if equity falls below 20 billion, then you have to go to do a recapitalization. And incidentally, that was also the first working day for our new governor. So essentially, his first task on the job was to do something that no governor had ever done, more or less, in modern times, which was to actually go to parliament and ask for a recapitalization. On the right-hand side, you see a chart that we produced as part of as an application of our analytical framework, where on the left-hand side you see the probability of another recapitalization being needed between 2024 and 2026, and on the x-axis you see how much equity injection would the Riksbank receive from Parliament. And of course, the larger the equity injection, the lower the probability of a need for yet another equity injection. And you see there essentially that you need something like 60 billion in order to reduce that probability down to something that you might think is perhaps acceptable, like 20% or something like that. What happened in practice was that the market did some work for us in the sense that market developments meant that equity bounced back, maybe 15 billion or so. Parliament decided to inject 25 billion, so a relatively modest amount. And that's where we are now, essentially. But the nice thing with the analytical framework is that you can then use various assumptions and you can test how important some assumptions are, like what you think about average term premia, average nominal interest rates, real rates, all those kind of things. And then you would get sort of lines looking very similar to that one, but a little bit higher or lower depending on the assumptions that you actually vary. So the final thing is essentially to sort of say, what happened, and that was that the Riksbank, and this is outside the paper, there was a final chapter to this story that came out after our paper was finished, and that was essentially the 25 billion transfer from the government. There was also an adjustment of the floor. So capital was now supposed to include revaluation accounts, which was not the case before, excluding gold. So it's now, if the sum of capital and revaluation accounts excluding gold falls below this 20, then the central bank may initiate a recapitalization discussion. Before it was must, now it is may. And the final thing that happened was that we got something akin to a non-remunerated reserve requirement for funding purposes explicitly. So if actual equity is below the target, then the difference between the target and the actual equity will be applied as non-remunerated reserve requirement on the banking sector and distributed across some keys, essentially. So that will add a third source of cost-free funding for the central bank. On top of cash and capital, we now also have access to this sort of non-remunerated reserve requirement. So let me stop there. Thank you.
Thank you, David. I would propose that we immediately go to the last session, session 4, which addresses the challenges from climate change for financial stability and thus for central banks' roles in this field. Let me warmly welcome Dirk Schoenmaker, Professor of Banking and Finance at Rotterdam School of Management, Erasmus University and SUERF Fellow. Dirk, how might the transition challenge financial stability and the lender of last resort role of central banks?
Thank you, Ernest, and also thank you for the kind invitation. First of all, transitions, whether they are related to climate, to biodiversity loss, or to social unrest, which we have seen, like in North Africa, they happen shockwise and are systemic. You cannot predict them. You cannot see what's exactly happen. Then what's the impact on financial stability? And how to go forward. And I will argue for a macro rather than a micro approach, what is currently happening. So transition, and that's quite different from economics or finance. This is from my colleagues from sociology. So you have the current system, you optimize, but then you destabilize, you get disruption. At the bottom end, new companies, new concepts, people are experimenting, they're accelerating. And in this case, for climate, it is the renewables versus the fossil fuel. And then at some point, you get the chaos in the middle. And we don't know exactly how that will develop because it is in the future. But at some point, you can imagine that fossil fuel companies will become stranded assets, or as some people would argue, a sunset company. So they go till the end and then the sun sets on them. And then the renewables will be the new norm. We don't know when it happens, but how to prepare for this type of shock. And this is just an example from fossil fuels because we talk about climate, but you can have the same on biodiversity in the Netherlands. I have several colleagues from the Netherlands. This is basically also what's happening in agriculture in the Netherlands on nitrogen. Next slide. And the key thing is it will lead to losses. So this graph on the vertical axis, we have the demand for electric cars. So basically, that's the new world. And on the horizontal axis, time in years. So Tesla in 2020, Tesla was on the curve and providing full, could provide for the demand for electric cars fully. Volkswagen, I could have taken any other European car maker, was behind, and let's say at 40%. And if they don't recoup, then in 2030 or in 2035, or if the German Chancellor succeeds in 2036 with the negotiations in Brussels, then it stops with combustion cars. And if you don't have the capacity, you face a huge loss if you're not prepared for the future. And in this case, if you're only prepared for 40%, you can lose up to 60% of market cap. And that sounds a lot, but we know that the value of Tesla is higher than the combined European car companies. So this is happening in real practice. My students looked it up when I was teaching this, and then that's exactly what we saw with the Volkswagen share price that had dropped more than 50%. So it has an impact on value stranded assets. And then the question is, what approach, because this in the end, the loans which banks have extended to companies which are at risk with stranded assets, should we have the traditional micro-prudential approach, where you see there's an exogenous shock coming from outside, and you have bottom up, you make some capital requirements on historical data, or is it endogenous and you see it as a system-wide risk? And I would argue that's the same with housing prices and credit growth, which before 2008, we didn't look at from a macro perspective. And then we spectacularly missed the crisis because we have an up-to-date Basel II full risk-based, and still we had problems. So my argument is for climate, we also need a macro approach rather than only micro. So we have a tendency to be active on the micro side. We have more instruments. We have the Capital Requirements Directive, we have Basel. And then we are tinkering with Pillar 2, warnings, do we get add-ons? Pillar 1 is even too dangerous for everybody because we need historical data, and this is in the future. So there's a tendency to be late in the day, but still to go on the micro side. And on the macro side, we do some climate stress tests, but that's about it. And we are talking about what to do. We may miss what's happening by not looking from a macro perspective. So the question is, what instrument? A report from the European Systemic Risk Board 3 years ago. And we have now this new instrument of systemic risk buffers, but they do very little because you increase the buffer a little bit. We have this paper, Micro Capital Requirements for Banks from London, and it shows very clearly if the loans are very profitable still, then the extra capital you can absorb in your profits. So a risk buffer is not always stopping banks from doing it. It makes it only more expensive. Is the buffer enough to buy it? Look at countercyclical capital buffers. They didn't. You're late in the day to start them, and do they really buy it? And our proposal is, if we see it as a problem, why don't we really require banks and other financial institutions, because there's a cross-sector problem, otherwise you get arbitrage. Why don't you require financial institutions to go to net zero? And then the question is, net zero 2050, how do we do it? Again, on the y-axis, we have the amount of carbon emissions. We go to net zero in 2050. Which pathway has the minimal disruption? So we are currently, as we have written from the Academic Scientific Committee already many years ago, we are still on the too late, too sudden scenario. So we do too little. And then if we get closer, global warming increases, we increase the requirements, carbon taxes go up. Or we can have a straight line, or we go too fast. We really reduce it a lot. If I ask my students, they're young, they would argue for the bottom one. So let's speed up so we reduce global warming. I think in this audience, including myself, we are a bit older. We argue that if you want to minimize shocks, then the straight line could minimize shocks. And that means in 25 years, we go down to zero. So that means from your current emissions, whatever they are, you get 25 steps of 4 percentage points back to zero. This seems very rigid, but our colleagues from China, they were early in the day on climate and they had credit guidelines. It's more or less similar. You say where you put your credit. And in Europe and in the US, we stopped doing giving guidance from the central bank. But I think in China, they did it early on when they started to look at sustainability. And if we really want to nail it, we may need to think about it, because fossil fuel loans are currently profitable. So there is no incentive at all for banks to stop them, given that they are profit driven. And if the central bank does not intervene macroprudentially, only tinkers with buffers, very little will happen. That's our premise. So that's why I gave the early picture. We are up for major shocks. And for those of you who follow the climate reports, global warming is going faster than the best climate models can predict. So, and we see it in the weather patterns. So major shocks are on their way. And how do we want to disrupt them? And putting it in the foreign currency literature, can we plan for an orderly and soft landing? And our proposal is financed carbon emissions, whether it is pension funds, banks, or insurance companies, that you reduce them stepwise. Then you can reduce the involvement of the financial sector, and also in the real economy, of course, you give an incentive to put down fossil fuel use, and you incentivize renewables, because it is not, financing is not available anymore, or less available for the fossil ones, and by definition then more available for the renewables. So you you steer the shift top down in the central bank. Of course, in tandem with the government, carbon taxes are first best. But given the amount of carbon taxes we have, this is what the central bank could do. Thank you.
Thank you very much, Dirk. Now we have just 5 minutes left. I would have 3 short but difficult concluding questions. First question is, so all in all, are central bank losses a problem for the credibility and efficiency of monetary policy to deliver on their mandate at the least possible real economic cost? Second, given current very diverse arrangements of how to deal with central bank losses, what would be the best practice or benchmark in your view towards which central bank financial arrangements should converge, ideally in the future? And third, if there were to be no one size fits all, why not? What would be the main determinants of optimal capital and financial arrangements for central banks? So if possible, I'd invite Chris, Erceg, and Dirk Broeders to start out, and then anybody who has something to say, please come in.
Well, thanks, Ernest. So my sense is that central banks, as Christophe Kamps indicated, you really don't face an acute problem on delivering in their mandate at this point. And I think really the concern is that a weak capital position could put a high degree of pressure on central banks that can potentially dissuade them from taking needed policy actions. And so, I think this has been really a great session to help think about ways of identifying the risks to central bank capital positions, as well as to try to take remedies to help address these risks. So in terms of I think difficulties, central banks might be dissuaded, for instance, from engaging in QE if they if they basically are pressured to really think mainly about their capital position in taking these policies. So I think that we definitely don't want that to happen. We don't want central banks to be forced to take the sort of actions that we often have seen in emerging markets, where countries have to try to recoup, central banks have to recoup through basically imposing taxes on the banking system. And so basically engaging in a lot of distortionary practices. So, I think it is a problem. It's very good that we had this session to think about it. I don't think that there's really any sort of one-size-fits-all remedy that is really appropriate in addressing it. As I mentioned just briefly at the end of my talk, central banks that really feel like they have strong credibility and the sort of organic revenue stream through seniorage to be able to eventually build up their balance sheet. They satisfy the intertemporal budget constraint that Willem Buiter had indicated, then they can do so. And they can retain that sort of approach. Even then, I think that communication about what they're doing is really essential to build support for policies like unconventional monetary policies. Now, other central banks, and I think I have quite a bit of, I think I'm quite favorably disposed towards this. You really can move towards more risk-based approaches. And so if they are accumulating profits at the early stages of QE to alleviate financial stress, to support the macroeconomy as typically happens, they should hold on to some of those profits. And that can keep them in a better position subsequently. So that's my quick sense on these. They're tough questions, but certainly no one size fits all.
Thank you. Dirk, what's your go at these questions?
Very good questions. So I would also say there is no acute problem, but we also have to recognize that the world is different. There is an ongoing process of still absorbing the losses from the past monetary policy operations, and there can be an unexpected event where new programs and new measures need to be taken. My message would be we need to be much more forward-looking, anticipating future uncertainties, do scenario analysis, do stress testing, more risk assessments to see how we can prepare for future shocks, potential surprises. I guess all these capital policies are very local, embedded in local legislation and central bank rules. Probably very difficult to change them also, but what we can do, of course, is learn from each other. And I think this event, the book, and I think all those people working on this topic, I think it's good that we learn from each other to see what can be used in your own jurisdiction to be more precautionary in anticipating future shocks. Again, my point is a strong balance sheet is necessary for independence, financial independence, and credibility. We had huge buffers before the interest rate hike. If that hike would happen again shortly, we of course start with a less favorable position. So again, from a long-term perspective, I think we should be more forward-looking in seeing how we move ourselves through a next shock. Will at some point, obviously, will be there. Thank you.
Are there any further comments? Yeah, Dirk.
I'm happy to have a short one.
Yes, please.
Ernest. If you look a bit broader, I think Willem made clear that the central bank is part of government budget. For example, if you run a railway, typically the shares are also held by the government of the railway company, and nobody worries if there is a loss and a negative equity as long as the government is owner of the railways and is behind it. And there is government budget to let the train runs. And no consumer is worried that the train would stop. So I know that in central banking, you love to have your independence and you define it by having your own capital. But I think if you look a bit broader, other sectors which are also steered by the government, other public parts of the sector, they are less worried about it because they don't have seigniorage. So there's no need to be overly worried as long as it is clear the intertemporal constraint, of course, should be abide by that you can still operate.
Thank you very much. I think with this, I would then conclude this SUERF BAFFI Bocconi e-lecture on central bank capital in turbulent times, the risk management dimension of novel monetary policy instruments. Thanks to Christopher and Christophe, Ulrich and Kathryn, Willem, Matteo and David, and to Dirk for sharing your knowledge with us. Thanks again to the members of the organizing committee, Dirk, Art, and Matteo for helping set this e-lecture up. And to all of you for your interest and for joining us today. I think it became clear how rich and worth reading the book underlying this event is. A big thank you to the authors and to the editors for making this book accessible for free. You find the link to the book as well as the slides on the SUERF website. Bye-bye and take care.
Bye-bye.
Thank you. Bye-bye.
Thanks very much.
Thank you.